Welcome to GEPL Capital Talks on Tuesday, a weekly podcast, bringing to you an interesting talk related to finance every week. Stay tuned. Subscribe now and press the bell icon to GEPL Capital's YouTube channel and never miss out on any stock market update and build your knowledge on investment. Hello everyone, and welcome to our Tuesday's weekly podcast. This is our episode number 62. And today we have with us our investment advisor, Ruchi Mehrotra, who has over a decade of experience with growing wealth for individuals and families. And before we start, don't forget to press the bell icon and subscribe to YouTube channel. We promise we will make investing easy for you. Over to you, Ruchi.
Hi, Lakshmi, and thank you for this. So today I'm going to be talking to you about the 3 financial ratios that we think will help you make better investment choices while evaluating equities. So before we get into the 3 financial ratios, let me just give you a little bit on what are financial ratios. Financial ratios offer a way to evaluate a company's performance and compare it to probably competitors or similar businesses in the same industry or sector. Ratios measure the relationship between 2 or more components of a financial statement. So this was about financial ratios. And the first ratio that I'm going to be talking to you about is debt to equity ratio. Now, debt to equity ratio, what is it used for? It's used to evaluate the company's financial leverage and is calculated by dividing a company's total liabilities by its shareholder equity. Now, why is this an important matrix? It lets you know the amount of leverage the company has taken. And it's usually a very, a very important one that one uses in corporate finance. Now, generally, the lower the ratio, the better it is. Anything between a 0.5 to 1.5 in most industries is considered good. Again, to calculate the debt to equity ratio, you have to divide the total liabilities by the shareholders' equity. Now, the second one that I'm going to talk to you about is the return on capital employed, or the ROCE. So what is the return on capital employed? It is a financial ratio that can be used in assessing a company's profitability along with its capital efficiency. In other words, the ratio can really help you understand how well a company is able to generate profits from the capital that it's put to use. Now, how do you calculate this ratio? It's calculated by dividing the net operating profit, or the earnings before interest and tax, which is also known as EBIT, by the capital employed. Another way to calculate this is by dividing earnings before interest and tax with the difference between the total assets and current liabilities. What does this do? This ratio tells you how efficiently a company is able to use its capital to generate profits. Now, the third ratio that I want to talk to you about is the asset turnover ratio. So what is the asset turnover ratio? It's the relationship between the net sales of a company and the total average assets of a company that a company holds over a period of time. Now, what does it do? This helps deciding whether the company is creating enough revenues to make sure it is worth to hold a heavy amount of assets under the company's balance sheet. Now, in simple terms, it is, what does it mean? Asset turnover ratio tells you how much revenue you earn on the basis of the total assets that you have.
Thank you, Ruchi. This was really insightful. The three ratios discussed today gives us an overview of the three broad areas of a company, that is liability, profit, and sales.
Absolutely, Lakshmi. There are several ratios, and what we've tried to do here is, look for the three important ones that one could start with to evaluate a company, and then going forward, dig in deeper, and as separate different industries, different sectors have other matrix that you could follow as well.
Yes, this is a very good start, and hopefully, we will help you make better investment decision. Also, you can follow us on Instagram, Twitter, and Telegram for where we are talking all about investing for you.
Thank you, Lakshmi, for this. Thank you very much.
Investments in securities market are subject to market risk. Read all the related documents carefully before investing. Investors must make their own investment decision based on their specific goals, financial position, and risk appetite. The content provided herewith is purely for information and educational purpose only.